I'm Neil Shah, Director of Content and Strategy at Edison. And when we were debating the themes to put on here, you've got two panels which are talking about some megatrends, but there's an interplay always between those megatrends and the world of finance. And I thought that the M&A panel would be an interesting topic to take a look at. We have three panelists. They're going to go in the order that they're in the brochure. One focusing on the healthcare market, one looking at the sort of turnaround opportunities, and one which is a sort of listed private equity vehicle operating in the consumer tech. And I'll let them explain or introduce themselves and their businesses. But just to do a little bit of scene setting, I'm going to quote from the PwC 2004 M&A Outlook, which starts with, "We're hearing the starting bell sounding for an upswing in M&A activity, signalling an end to the worst bear market for M&A in a decade. Whilst the strength and speed of that recovery remains uncertain due to lingering macroeconomic and geopolitical challenges, we believe we have reached a tipping point. We expect the M&A market to embark on a new upward trajectory with a steady increase in activity as the year progresses. Indeed, a flurry of deals in the past few months suggests that this rise in deal making may already have started in some sectors." And if that's to be believed, then we are at the end of the worst M&A market that we have seen since the global financial crisis. Just to put some context around it, in 2021, global M&A deal value was around 5 trillion. In 2023, it was half that number at 2.5 trillion. In terms of deal volumes, 2021, that was at 65,000 deals. In 2023, that was down 17% to 55,000. But actually, when you look at the makeup of that, most of that was the mid-market holding up where it was possible to push through the deals in a tougher financing environment. The mega deals characterized as those above 5 billion were down 60%. What's cause for optimism? Well, firstly, and hopefully some of this you might hear in the sort of panel's reflections, improving financial markets, particularly a slightly more stable debt market, which is important in terms of driving the M&A side of things. Secondly, there's pent-up demand. And there's a lot of people who want to do these deals who've been frustrated not being able to push them forward. And then thirdly, a good reason for doing an M&A, pressing strategic need for many companies to adapt and transform as these sort of mega trends. And the panels that come before and after are two examples of those mega trends and how companies have to adjust. The interplay between public and private markets is interesting. I think what's when you're looking at the private equity space, which a lot of people focus on in terms of a key driver of the M&A market, it's very well sort of known. There's record levels of record levels of dry powder sort of sitting on the PE books, $3 trillion. What is perhaps less well understood is just the age of that. A lot of that is now growing to 4 and 5 years old, and will effectively pass without earning fees if it's not put to work. And so private equity hasn't been immune from these global trends. 2021 deal values, they did about 11,000 deals. That was down 27% in 2023 to 8,000. But with this motive of dry powder starting to burn a hole in the wallets, slightly more sort of challenging IPO markets, meaning that actually there's an incentive effectively to try and realize value in other ways, roll-up strategies, etc. Valuations starting to improve, and a slightly more sort of stable debt market. The signs are there that the market is going to start turning. And the panel that we've assembled, I think, have all got great track records in terms of delivering shareholder value and realizing value from these opportunities in very, very different ways. And I'm going to hand over to Claude to start and explain how they see the market in the healthcare space and M&A in particular.
Thank you very much, Neil, and thank you to the Edison team for inviting us on this panel today. I'm representing BB Biotech, that is a Swiss-listed investment company investing into the biotech space. 2.5 billion in market cap approximately, trading on the Swiss and German stock exchanges. BB Biotech was founded more than 30 years ago, so we've been around for a while. We're investing primarily into actually public biotech companies, so we can invest up to 10% of our money into private companies, but currently we just have one private holding. We have approximately 30 stocks in the portfolio today. Over the history of BB Biotech, we've been involved with many M&A transactions, so actually M&A is an integrated part of the healthcare ecosystem, I would say, and in particular in biotech. So we have seen a significant pickup in deals in the healthcare space, I would say in Q4 last year and Q1 this year, and in particular in biotech, where we've seen approximately 45% of the deal value in healthcare being in biotech companies. So that is reassuring that something is definitely happening in this industry. There's quite a clear reason for this, especially in the biotech sector. So big pharma companies, they are to some extent swimming in cash. They have low R&D productivity. They have patent losses, and they have difficulties maintaining their growth rate. So a natural way for them to actually expand their top line as well as bottom line is to take over biotech companies. What pharma companies are looking at is, especially in hot areas such as ADC and radiology, but what they're also looking at is, I would say, late stage or even commercial companies, so companies that have drugs on the market already. Pharma companies tend not to take too much risk in their acquisitions because they have the cash and they need the revenue streams now. So they seem to be more fond of late stage acquisitions as such. We have seen some acquisitions even from local companies here. So AstraZeneca did 2 deals in the oncology space quite recently, and these deals were done at significant premiums to the stock market value of the company. So one of them at approximately 60% premium, and the other one just shy of 100% premium. And that is not unusual in the biotech space, that these companies are taken over at big premiums. As I said earlier, there's a natural collaboration, I would say, between biotech and pharma. The pharma companies do lack growth and they do lack R&D productivity, but what they have is actually big commercial operations, and that's where the biotech companies cannot contribute a lot. So we have some biotech companies building out their internal infrastructure in commercializing their drugs, but biotech companies do start out by R&D and being focused on scientific development, etc. So it's a natural, I would say, collaboration, and it's a natural evolution in the biotech space. Other than that, I would say that we do expect M&A to continue in the sector. We cannot see why it should slow significantly down. Pharma companies still are in need of revenue streams and new products, and they do have the cash available, so they're not too dependent on the debt markets as such. So we are optimistic towards the future, and hopefully we'll see some of the transactions being from our portfolio. We do not play an active role in M&A as such, so it's not like we're pitching our holdings to big pharma companies. Big pharma companies have their eyes open. They do track the whole biotech landscape, so there's no necessarily no need for us to play an active role there. Thank you.
Thanks, Claude. Naturally, in the Q&A, follow up in terms of interesting areas within the healthcare space. Our next speaker, I mean, if you view the content on the Edison platform, I was fortunate to be able to interview the founder of this business, who told me that he had set it up with, I think, his own capital of, I think, 50,000 euros many years ago. It's now a 5 billion euro company listed in Germany. Delighted to have Ivo Hobson, the head of the UK from Mutares, come and talk to us about Mutares and how they are able to generate value from turnaround.
Thanks, Neil, and thanks to the Edison team for having me along today. As Neil says, I'm representing Mutares. We're a turnaround investor founded in Munich back in 2008. We've been present here in London since 2019 and now have a presence across the world, 11 offices in Europe, and 2 now in Asia, 1 in Shanghai and most recently in Mumbai. Just some points about our structure, as Neil alludes to. Firstly, we're a listed business. We're listed on the prime segment of the Frankfurt Stock Exchange, and since December last year, in the German SDAX, we have a market cap of close to 700 million euros, which will please Robin, no doubt. Second, and I think this is important, we are not a fund. We don't have a captive fund that we're deploying. We're a balance sheet investor investing our own capital. And to that end, you can think about us slightly more like an industrial holding company. And that influences the way we think about investing and the transactions we look at. And if you were to log on to the Frankfurt Stock Exchange, what you would see there would be the results of all 32 of our current portfolio companies. Finally, and most importantly, consulting is at the core of the way we think about investing. Within that industrial wholeco structure I allude to, there is a topco, a traditional GP-style vehicle, that has about 250 employees, and 160 of those are operational consultants. They're ex-industry or ex-McKinsey, Bain, Big Four, and one of the key revenue streams for that business is the time of our consultants. We always seek to invest into operational turnaround scenarios in which we can deploy these individuals to sit alongside management and then implement the improvement measures we have identified during the diligence phase. So in that sense, we're definitely not financial engineers, and we do not seek to invest in opportunities that require significant balance sheet restructuring. There are many players in the market who are much better at us than that. We are P&L specialists, and we focus on operational turnaround situations and corporate carve-outs. My job is to identify underperforming businesses or non-core assets of corporates into which we can deploy that consulting base. Our portfolio currently consists of 32 companies, aggregating 6 billion euros of turnover and across 4 industry segments. The first is automotive, which is mainly on the continent. There's not so much to invest in here, sadly. Goods and services, which includes the most recent UK transaction we did, the acquisition of a business called Greenview, an M&E building services company based in Belfast and Northern Ireland. Food and retail, which includes a Prenatal, a baby retailer in the Netherlands, and Le Pair, a manufacturer and distributor of home equipment products we carved out from Saint-Gobain in 2021. And finally, engineering and technology, which includes our 2 UK rail assets, AD Comms and Gemini, which are rail refurbishment businesses. And it used to include Special Melted Products, a business we carved out from Allegheny Technologies in May 2022. We sold it to Connier, the Italian strategic, in September 2023. And I'll just pause on that for a second because it's a textbook Mutares transaction. Post the carve-out, which we completed in May 2022 and cleared under the UK National Security and Investment Act, we took a historic business which has been making steel in Sheffield since the middle of the 19th century and invented stainless steel back in 1913, which was supplying drill collars to the oil and gas market, to the oilfield services companies like Halco and Baker Hughes, but also engine shafts to Rolls-Royce and other members of the aerospace supply chain. On acquisition, it was heavily loss-making and cash-burning because it was run as a melt centre for Allegheny Technologies in the US. It had a DB pension funding gap, which, not being a fund, we were able to look at, and had several operational weaknesses: poor contract pricing, production bottleneck, poor sales function, and was over-reliant on oil and gas, and therefore had a highly cyclical top line. Our business case focused on managing the order book, leveraging the rebound in oil and gas, which you could see already before the invasion of Ukraine, and tilting it more towards aerospace, which is a much more stable business, has higher margins, higher barriers to entry, commands a higher exit multiple. We reorganised the indirect functions and we unlocked the production bottlenecks by making some key investment. This led to a swing in EBITDA from a run rate of circa minus 20 million of 60 million turnover on acquisition to plus 15 million of 110 by the time we sold the business last September, which represents the largest exit in our history. Just to touch on the market, I think as Neil alludes to, it was a very slow year last year, but already this year we're seeing a significant increase in activity. This is in sectors you might expect to see, for example construction, and in typical Mutares transactions, corporate carve-outs. It seems the corporates are making decisions again as the macro landscape becomes more certain. But we're also seeing, and this is the most interesting point for me, an increase in opportunities to invest in what you would call fundamentally good businesses. The resultant of the last few years, the pandemic, supply chain shocks, inflation, and rapidly rising interest rates have hit a very understandable bump in the road. So we feel it's a very important time to be quick and nimble, and that we should have a successful year where we can value add and make a difference across a number of sectors.
And last, and then I'm very keen to make sure that we do open it up to Q&A for the panel. James Sola from Oakley Capital. Oakley is a business I've known for many, many years and has actually flourished, particularly over the last 3 or 4 years. James, over to you.
Thank you, Neil. And yes, thank you to the Edison team for setting up today and for inviting me to present. So a quick elevator pitch on Oakley Capital and Oakley Capital Investments. So OCI, Oakley Capital Investments, is a listed private equity trust listed on the London Stock Exchange. It invests exclusively in funds managed by Oakley Capital, and Oakley Capital is a pan-European mid-market private equity investor. Oakley invests across Europe, mainly in privately owned, so not public, private mid-market businesses. And we invest across Germany, France, Spain, the UK, and many of those companies, although they're European, are increasingly having revenues outside of Europe, especially in the US. We invest across 4 core sectors: technology, consumer, education, and business services. And within those sectors, technology will tend to be SaaS businesses, software as a service, or internet infrastructure, such as web hosting businesses. And there we're investing behind the mega trend of businesses shifting to the cloud, for example. Within consumer, it tends to be digital consumer, but also non-digital. And we really like businesses such as price comparison websites and digital marketplaces. For instance, we're invested in Facile in Italy, which is Italy's answer to moneysupermarket.com. We're invested in Idealista, which is Spain's answer to Rightmove, for instance. And we like those plays because digital penetration rates in Southern Europe are much lower than Northern Europe, especially in the UK, so there's a huge runway for growth there. Within education, we're probably one of the most prolific private equity investors in this space, and we invest in the whole life cycle of the student, if we can say that, from early years nurseries through to K-12, through to tertiary and university education. For instance, we are invested in IU Group, which is Germany's largest and fastest growing university, essentially an ed tech business with about 140,000 students. And then within business services, this is a fairly new sector for us in terms of building a team around that. We invest behind B2B information platforms, very often with recurring revenues, which we like because it gives us income visibility and often attracts a higher multiple at exit because investors like the reliability of those revenues. And also TIC businesses. We specifically like business services because of the non-cyclicality of the underlying businesses, the non-discretionary nature of the service they provide, and also the fact that these tend to be highly fragmented markets ripe for consolidation. Couple of stats on current performance. Average annual EBITDA growth is about 14%, so we're still managing to generate double-digit earnings growth in a high inflation environment. Now this is slightly down on previous years, but against the wider economy, especially in Europe, it's a pretty good result. average net debt to EBITDA, which is a key metric that investors in PE trusts look at, and wider private equity, and especially at a time when there's a lot of focus on leverage and the use of leverage by private equity, is about 4.2, which is considerably lower than the market average of about 6 to 7. And our average valuation multiple is just over 16 times, so demonstrating again, in terms of valuations, we are quite cautious and prudent in how we value our businesses. In terms of what kind of businesses we like, apart from the sectors I talked about and the geographies, we like founder-led businesses. So about 3/4 of the deals, 3/4 of the businesses we back are founder-led. That's really important for us. We want the entrepreneurs we're backing to have skin in the game. We like to back exceptional entrepreneurs who have a proven track record of creating fantastic businesses and or have a proven value creation strategy that we can invest behind. They tend to reinvest alongside us, and as I said, that's very important. They invest in our funds, and very often we do repeat plays with them. So for instance, we have done our 6th deal in the web hosting space with the same 2 German entrepreneurs we first partnered with 10 years ago, and that's really important for us. Some of the recent deals we've backed, it has been a bit of a downbeat period for M&A, not just in private equity, but the wider market. It is deal values down about 40% in 2023, but we've had one of the busiest periods we've ever had at Oakley. We've done about 6 to 8 deals in the last 9 months. Within business services, here in the UK, we backed a business called Steer Automotive Group, which is the UK's largest independent accident collision repair network. Richard Steer set up the business in 2018, fantastic track record in M&A and buy and build, and this is a fantastic market ripe for consolidation, and he's going to play, and his business is going to play a key role in that. Liberty Dental Group, again a fragmented market across Europe in terms of dental labs. We're backing an entrepreneur and a carve-out from an established business to build a network of dental labs across Europe. Thomas's, which is a group of premium K-12 schools here in London, and also some really interesting tech deals recently across Germany and especially in Spain. Alerce, which is transport and logistics and software, Web Central, which is a web hosting business, and just today we've just announced our latest tech deal, which is Vitro Connect, and that is a German business in the wholesale broadband market, and it's a play behind Germany's accelerated catch-up with fiber broadband because they're falling way behind other countries in Europe. So in a nutshell, we've had a pretty good period for M&A. We've got a strong pipeline. We're looking to deploy more capital across our core sectors, and I will leave it at that, and we can get on with Q&A.
While that mic is getting there, Claude, can I ask you in particular, you talk about large pharma doing this. Are there any particular sort of indications or areas? Because when you're looking at what is hot in the healthcare space, for years, oncology spend was where you'd see that there was a little bit of a tilt on that at the time of the pandemic, and I think you're starting to see that sort of coming back. Is there a particular areas that large pharma is focused on?
Yeah, you're completely right that there are certain disease areas that seems to be in favor at certain points in time. But I would say the recent deals that we've seen in both in Q4 last year and Q1 this year has actually been mainly in the oncology space. We've seen some deals in inflammation and autoimmune diseases as well, but mainly oncology. Then we've seen a few deals in neurology, so that's an area where we have not seen so much in the past. So we've seen some big takeovers of neurology or CNS focused companies, so within brain diseases. Yeah.
Yes, thank you. I wanted to ask about private public. So if you look roughly over the last 10 years, we've seen massive amount of money coming into private equity and a lot of money going out of listed mid-cap and smaller cap funds. As a result, we've got very low valuation across the board. I'm talking about Europe in general, including UK, the whole area. The NAV of private equity hasn't come down very much, but listed private equity funds are trading at a big discount. The market is not full. There is a discrepancy between private value and private equity valuation and unlisted world. You mentioned leverage 6 times to 8 times in private equity. Any listed company, small cap or mid cap, at 4 times EV to EBITDA would absolutely be, 4 times debt to EBITDA would be decimated. Wouldn't have any equity left at this point. So isn't it time that private equity sort of smell the coffee, and if you want to see M&A and say health, you need to be a bit more realistic about valuation in portfolios?
Well, there's two people who spend their time buying companies here, so maybe I can ask Ivo, maybe you want to give a view on that. I mean, clearly you're looking for the best possible deal, right? But what are you seeing on that?
That's right. I mean, our business model is slightly different. We're not financial engineers, and we're not leveraging the companies in the same way that more traditional financial players are. And I think that's why we are actually quite well placed, given the state of the market. I think it's hard to disagree with that sentiment that over the last 10 years, the macro landscape has seen investors become heavily reliant on leverage and finance. And I think the time's changing, James. I don't know how you think about that.
Thanks, Ivo. I'll tackle the question about valuations and the discounts, because that's a key question for PE trusts in general. I'd say the key things to look at, the way that the industry, if we can call it that, can reassure investors, is a couple of points. One, frequent valuations or revaluations of the whole portfolio, and ideally that should be done on a quarterly basis. Full audits of those valuations on an annual basis. I think investors can take some reassurance looking at the premiums on exit. So you've got the discount to NAV, but on average across PE trusts, the premium on exit on the last underlying value of the business you're selling is about 30%. So there are real investors out there, whether they are other private equity buyers, blue chip, private equity, etc., who are willing to buy those businesses at a premium to the carrying value. So that should be some reassurance. I think that the industry as a whole probably needs to do a bit better in terms of communication and communicating that they are revaluing portfolios on a regular basis. And I think once that happens, and you see the M&A market come back to life, hopefully some of those discounts will close. I'd also say, in terms of leverage, I think there's leverage, and it depends on the company. A slow-growing company in an old economy environment won't perhaps be able to take on so much leverage. But if you have a company that is growing earnings 20 or 30% every year, that company is going to double in size in 2 to 3 years' time. And so leverage on the 1st of January compared to the 31st of December is necessarily going to reduce over that period if you can sustain that earnings growth. From our point of view, we are quite cautious and conservative on leverage, and we have tended to put a bit more equity into our deals than debt at the moment, because it just makes sense, because debt is a bit more expensive right now.
Thanks. And I'll add one thing, and if there's any other questions, please do raise your hands. I'll get Liz to take the mic to you. So the stats from Verdad, which looked at the market as a whole, and these things come in cycles. So it was interesting that in 2023, for the first time, public markets actually demonstrated better growth and EBITDA margins than the equivalent component in the private equity space. And I think that if you're reading a lot of the literature in terms of the road ahead, debt is more expensive. And so actually the work that the private equity firm has to do in terms of realizing value is much more akin to what I think Ivo and his team are doing, which is going in, actually taking an asset, improving value. So it's going to be a harder road going ahead in terms of you can't just step in and do a leveraged deal and hope to realize value on just financial engineering. You're going to have to work harder to get that value. Were there any other questions?
Yeah,
one at the back.
Yeah, hello. Andy Brown here, Rowan Dartington. I think it's more aimed at the last two speakers, but all the companies I meet say sort of much the same, really, in terms of they like founder-led, they like the culture, they like skin in the game. So from a competition point of view, bearing in mind there is a fair bit of sort of financial strength out there, if you come up against listed buyers, does this concern you? Is this, is it more of a challenge to persuade them to, go with you? Could you talk through that, please?
I think the answer to that question can vary. In certain scenarios, absolutely, because a listed or strategic player can bring value to the table that perhaps we can't. But often in the situations we look at anywhere where a company is in distress or in need of operational help, the management teams are quite open to people like us who are coming in, will bring change, send a full-time team of consultants to help free up their time, and it becomes a competitive play between us and our competitors. And if you're sat, you make a good point about financial strength out there. When we're competing against large funds who are seeking to deploy their capital in a certain time frame, and we're not bringing that to the table, winning the management team is probably the critical point for us. So it varies by situation.
Yeah, I'd add to Ivo's point. I think we are seeing a bit of a de-equitization of public markets. It's not just take privates. I think it's more and more founders who are preferring to go down the private equity route than IPO, because IPOing and then life as a CEO of a listed entity can be a bit of a faff. There's a huge regulatory burden, and then you also you are dealing or working with perhaps short-term investors who are only looking at 1, 2, 3 quarters of growth, as opposed to a longer-term strategic investor who will be there for 5 to 7 years. And to Ivo's point, will put in the money and the expertise, especially if they have a portfolio team behind them or a value creation team. You can parachute in experts around digital, M&A, internationalization, etc., to help them build their businesses in a way, getting support that they wouldn't necessarily get in the same way in public markets.
Thank you. Any other questions from the floor? There's one over there, I think.
I wanted to ask about, I guess, on the buy side team. Have you thought about moving away from equity and moving more into debt instruments, or investing across the capital structure, as debt provides better returns than it did 5 years ago? And secondly, how are you competing with the likes of KKR, Apollo? They have large private credit pools which they can use to fund their deals. How are you finding that dynamic?
It's more for you, I think, because you have your own fund, though. But
yeah, I think, look, we're sticking to our knitting, our sweet spot, doing what we've done well for the last 20 years, which is backing founders. It's not just about putting equity in. It is about the value creation drivers we can help with, such as internationalization, digitization, M&A, especially for fragmented markets. We look at unloved businesses, or business perhaps less professionalized, need a bit of help growing. We're not, I don't think we would move into a new strategy like that. We want to focus on what we've been doing for the last 20 years. And in terms of competition from the bigger players, look, I think they're offering something different. You've got a real bifurcation in private equity right now between the huge asset gatherers, where I think the name of the game is getting more and more assets you can charge fees on, and the smaller, more nimble niche players that are perhaps more attractive to founders who are, we were founded by a founder, an entrepreneur, so we find that with the founders we want to partner with, they like the less institutional, more entrepreneurial player who's probably more empathetic to them and understands where they're coming from.
And clearly you access the debt markets. Mutares does access debt markets as a public company. At an individual deal level, how do you structure that?
Yeah, that's a very good question, because at the minute, I would say unlocking the M&A opportunities is trying to play well in that interplay between the banks and the equity providers. You've got a situation where there's a lot of credit funds out there who are going to end up with the keys to businesses that they don't want in our end of the market, and trying to play in that and unlock the M&A, that's the piece that everyone's trying to think about. We don't have a debt fund ourselves yet. Query whether that's the direction we want to go down, because some of our competitors like Aurelius do, and they can just turn up in a situation and do both the debt and the equity, and that's a very powerful combination.
I can't see if there's any other questions. Yes, there's one over there.
Thank you. This is probably a question for James to answer. You're saying obviously a huge number of small, as you say, founded businesses as you look at investment opportunities. Can you talk a little more about how you see that kind of macro picture in the UK? Because we read the popular media always give such a negative view about what's happening in the UK economy. I mean, great to see those figures last week, which are much better. And I just get a feeling in the UK there's a lot of activity taking place, below what we call the big picture level. So can you give us your view about how you're seeing that picture across the UK?
Thank you for the question. It's a very good one. I'm afraid I might have to disappoint you a little bit in that the types of businesses we back tend to be market leaders or have the opportunity to become market leaders, and they tend to be very resilient businesses that will grow no matter what the economic cycle is. So in the downturn, they might take market share, and things are looking better, they might accelerate growth. If I think about our UK businesses, I mentioned Steer Automotive Group. It's consolidating a fragmented market. Dexter's estate agents with a focus on London, doing very well as well. So I'd say our UK businesses are doing well, but I don't know if that is necessarily, if that demonstrates the underlying health of the UK market or economy because of the nature of our resilient businesses, that they will grow no matter where we are in the cycle. I'm afraid, not sure if that's super helpful.
No.
I think we might have time for maybe one or two more questions before we hit time. If there's any other questions, please raise your hand. One thing I did want to ask was, clearly quite a lot of focus is in the press on the state of listed markets, particularly the UK market, and what is being done to change that. There was some conversations in the earlier panel about the pension fund reforms and actually accessing permanent capital for growth. How do you think about it when you're sitting at Oakley in particular, where exits matter and a functioning IPO market is valuable effectively? Otherwise you're just reliant on secondaries.
Well, it's a good question. I think we are less reliant on IPOs than other private equity firms. We often act as a bridge between the entrepreneurs getting their company to a certain stage of growth before the bigger, very often US private equity firms or pan-European ones, your CVCs, your KKRs, who've got hundreds of billions of dollars in assets between them, are then looking to invest alongside us, or we sell the business to them. So in some ways, public market valuations do matter, because eventually they might want to IPO some of those businesses. But by and large, we have found we have been able to exit businesses at healthy premiums to a lot of these investors. Now, I think there's a wider question about UK equity markets, and I come back to the de-equitization point. And it's slightly answering your question, Neil, but slightly not, but I'll make it anyway, which is private equity is growing as an asset class. There's no getting away from it. You have more and more pension funds allocating capital to it. I think it's really important now as an industry that we open avenues of investment for every investor. And you see larger firms such as KKR who are launching wealth offerings for mass affluent investors. I think listed private equity in the UK is a fantastic avenue for tapping into private equity for all investors. And as I said, as more and more founders are choosing not to list their companies, if investors want access to those high growth, innovative businesses who are shunning the private markets, public markets, your listed PE trusts offer a really interesting avenue for that, I think.
Okay, thank you. Lucy, does that mean time up or 10 minutes? Oh, I have time. Okay, fine. Any other questions out there? I can't see any hands. No, there's one over there. To one over there. Okay.
Yeah, just coming back to M&A, I think most people would agree there's been a mixed record of value creation for M&A transactions as a whole. So I'd be interested in knowing what you guys do differently that seems to have created a lot more value over time. So what do you do differently in your deals that other people don't seem to do in the general corporate world?
Why don't we start here? The secret sauce.
Our business model is very hands-on. It's not the transaction itself is not reliant on integrating synergies that you might see between two corporates doing M&A. We go through a very detailed process of identifying exactly where the value creation levers are, and then deploying a full-time team in order to implement them. It's not to say every transaction goes well, or as well as you would like, but I think that's our business model. It's very hands-on specific areas that are identified throughout the diligence phase, as opposed to being reliant on ultimate market forces and the realization of synergies otherwise.
And I guess maybe you want to talk about your investment process and how that realizes value.
Yeah, I mean, look, in private equity, one of the most successful value creation drivers right now is called buy and build, where we are consolidating fragmented markets. And the entrepreneurs we back either have a fantastic track record of doing it themselves, so we're buying into an M&A machine which is finely tuned, and they've got a proven track record of identifying, executing, and then integrating businesses. Or we're backing founders who've never done it before, never done M&A before, which is one of the reasons they might come to us, because we have expertise as well. So we will help scout out opportunities, execute, and then integrate those businesses. I mean, so-called bolt-on acquisitions for our existing businesses. We've supported our existing business probably do about 25 to 30 bolt-ons in the last 12 months alone. I think large-scale M&A, strategic M&A, especially between listed businesses, is probably harder to do. It's something we don't necessarily do. Just talking generally, I think one of the biggest make or break factors for M&A can be culture, integrating two different cultures. Going back to Ivo's point in terms of supporting your businesses, we have a portfolio team where we have experts in talent acquisition, so hiring C-suite and supporting teams for CEOs, data and analytics, M&A and legal communications. And so we can parachute in those extra resources to help the management teams, not just in M&A, but all the other value creation drivers we apply. But yeah, I'd come back to my 2 points. Either we're backing founders who are really good at it, or we have the in-house expertise to help founders who haven't done it before.
I'll just add to that if I can. I think in a corporate carve-out scenario, you have cases where you have an unloved business, but a really hungry management team, a bit like James and Oakley. We're actually unleashing them and giving them the power to think, supporting them with the team, yields quite fast results in non-core assets that have just been unloved or run in a way that wasn't purely for profit. For example, like SMP, which was just run as a melt shop to supply ATI in the US. You can unleash value quite quickly in those scenarios.
Yeah. And Claude, in terms of, from an investor perspective, particularly when you're looking at, the small and mid-cap universe, aware of the broader M&A trend, does it feature, exit routes feature for you in your investment process when you're looking at where you're deploying capital?
Yeah, so actually we do not consider M&A in our due diligence process, so this is not part of it, so to say. But we're looking at innovative companies that will grow at a high pace, and we're looking into technologies that are unique and can address unmet medical needs. And this happens to be some of the areas that the pharma companies are looking at as well. So it's not an integrated part of our process, but it's just a natural part of the game that sometimes pharma companies will take over some of our portfolio holdings.
Okay. Yeah. And there was a question at the front over here. Lucy's.
It's for the Oakley Capital people, and excuse me, I don't have the figures at my fingertips. I get the impression there are some private equity firms, specifically people like HG Capital, which are very focused, have very tight discounts, whereas yourselves, I get the impression, is much wider. What is it they're doing which you're not doing in terms of...
Well, I think HG is focused on SaaS businesses. And I think you've seen, if you look at public market valuations of tech enterprise software businesses, they've gone back up. They went down in the last 2 years after the COVID boom kind of wore off, and they've gone back up again. So I think HG is probably benefiting from that rebound in public markets. We have, we're focused on 4 core sectors, so we have more of a diversified approach. I think that, like other PE trusts, the discount is there. I think it's up to us to demonstrate performance, whether it's EBITDA growth or the premiums you've seen historically on our exits. And I'm sure we'll continue to see. which, if we keep doing that well, I'm confident that will help to close the discount. However, what I would say is, I think a lot of investors focus on the discount a lot. Really, if you look at NAV growth for OCI, it has tracked the share price quite closely over the last 5 to 6 years. And so I would argue it's more important, not so much where you get in on the shares, if you buy shares, where, what the discount or the premium is. More, are you confident that that NAV growth is going to continue, and therefore the share price increase is going to continue? And I think if we look at the investments we've made, the value creation drivers we have, etc., I think we should be able to sustain EBITDA growth. That is the foundation of NAV growth at Oakley. It's all about EBITDA growth.
Thank you, James. And with that, we are coming for take a moment to thank our panel. Claude, James, Ivo, thank you very much for your insights.